Did you know that India has over 7,000 listed securities? With so many options to choose from, it can be difficult to find the right stock to invest in. We are all familiar with stories of stocks like Titan, Infosys, and Asian Paints turning thousands into crores. However, for every Asian Paints, there are hundreds of dud stocks which lead to disappointment and lost investments. That is why we have created a multi-step process for shortlisting stocks. This process takes into account a company's valuation while keeping in mind its growth potential as well as the quality of its business and management. By weeding out bad quality companies or those with shady management, we ensure that you only invest in stocks with a strong foundation, poised for growth. Investors often fall into the trap of buying popular issues or optically cheap securities, but our process prioritizes quality over popularity. We know that for every successful stock, there are countless duds, and we don't want you to be holding any of them. That is why a thorough analysis guarantees that you'll only invest in the right stocks for your portfolio. So, if you don't want to let the vast sea of listed securities overwhelm you, then watch this video till the very end, as it will provide you with the tools and knowledge necessary to confidently invest in stocks with the potential to become multi-baggers. In this video, we are going to show you how to shortlist multi-bagger stocks so that you can create life-changing wealth. There are 3 steps to shortlist stocks. Each step helps an investor eliminate less attractive stocks so that he is left with the most attractive stocks that he can buy. Step 1 helps an investor weed out bad quality companies by removing those companies with illusory or inconsistent profits. Step 2 helps an investor separate these stocks into 3 buckets: high quality, low quality, and medium quality stocks. This is akin to separating apples from oranges so that each stock can be valued appropriately. The third and final step helps the investor pick the best companies in each category and create a portfolio of multi-baggers. Hi, this is Prashant Saraf, and you are on my channel Blueprint Investments. I am on a mission to arm investors with the knowledge, strategies, skills, and tools to create life-changing wealth for themselves and their family. Coming back to the video, let us next turn to the correct sequence of steps to shortlist stocks. The first thing an investor needs to understand is that finding multi-bagger stocks is not easy. Done the right way, it is a multi-step process. As an investor goes through these steps, some stocks that an investor initially found to be attractive turn out to be less so. The investor must have the fortitude to remove these stocks from their list despite the time they may have spent studying them. The stock selection process can be broken into 3 distinct steps. Step number 1 is weeding out the bad quality companies. So, companies may be unsuitable for 3 reasons. The first reason is that their profits are illusory. What we mean is that these companies are showing higher net profits but lower cash flows. Since cash flows are more representative of the true profits of companies, this means that part of the profits are not real. Now, companies can easily show higher profits by moving expense items from the profit and loss statement to the asset side of the balance sheet. While this will inflate the profits, it will not change the cash flow statement, which will still show a cash flow outflow. In other words, we need to weed out those companies that are indulging in unscrupulous accounting practices. The second reason to weed out companies is that certain companies may be showing low returns on capital employed. You must be wondering, what is return on capital employed and why is it important? Well, when comparing profits of different companies across different industries, we need a common yardstick, and return on capital is the best measure for this. Why is this so? Well, it is quite simple really. When buying equity shares, we become owners of a company, and as owners, we want to earn a suitable return on our capital which is employed in the business. For instance, if the return on capital employed in a business is below 8%, we could simply remove our money from the company and put it in a Government of India bond instead. In other words, since the cost of borrowing in India is high, any company earning returns on capital below 10% over the long run can be weeded out. The third reason is that companies may show inconsistent profits. We weed out such companies because we want to invest in companies that have a competitive advantage. Companies with competitive advantage have pricing power. Pricing power means the company will be able to pass on any cost increases to its customers without losing its own market share. So, a company showing inconsistent profits is obviously not able to pass on its cost increases to its customers, and it is therefore not a suitable avenue for our investments. After weeding out these three types of companies, we are left with just 500 to 600 companies out of the 7,000 odd listed companies in India. We will be covering step 2, separating stocks into different quality buckets, and step 3, choosing the best stocks in each bucket in part 2 of this video.